this divergence tells me that it's okay to stay short. And even when we have this impulse candle, which back in here, right, we had big green candle and then the big red candle. That green candle didn't have enough juice, didn't have enough momentum to not only pull the 5 EMA up through the T line to kind of start the trend change, but look where it failed. Right at that level. Now, that's not all bad, because actually what it's giving you is an opportunity to re-enter your short and feel good about it, because the divergence never broke, right? So yeah, did it get tight? Yes. But did you get a signal? No, you didn't. And then you have these two candles with equal tops at resistance, and that is an opportunity to go short, or if you got washed out, to re-enter your short. And to feel like that the probability of the trade working out is strong, because you're working off things that you can benchmark and see with your own eyes. Start to sense the fade. Here's the confirmation. If you didn't take it early at these dojis, that's fine. Breaking support, failing the tests, right? That first test that usually fails, quite often you'll see a move that's significant after it. And it's kind of what we got here. And as long as this divergence between these two levels stays intact, and you can see how the 5 EMA stays red, that's another cue, you're okay. And then guess what? You start all over again. But price is always going to range. It's always working from levels to level, which is kind of why we wanted to use this 4-hour chart. Let me take these off for a second. And if you can do anything, if you can trap price within a range, you're going to find that it's incredibly easy to trade. And when you, this is annoying, when you add the addition of the volume gaps, it gets even easier. And all of this stuff just repeats. And this is really important, because when we're volatile like this, when, these big swings up and down, as long as you're managing the risk properly and you're doing what you're told on the chart, you should probably be okay. And part of that managing risk is not using too much leverage, if you're using it at all. That will be your nemesis, and that will screw up everything for you. No matter what you're trying to do, or what system you're using to trade, or whether you're trading over short or long time frames, if you're using too much leverage, it will bite you in the butt. You have to be able to live to trade another day, right? You can't respawn your money, so you have to use stops. And in times like this, make sure they're tight so that disaster doesn't come back and bite you. And it doesn't matter what you're trading, we should be doing that. Now, if you're finding, let's say you're scalping and you're getting stopped out a lot, that's probably fine, because it tells me that you're managing some risk there and you're prepared to get stopped out so that you don't lose a ton, and you'd rather lose a little, and I'm okay with that. But if you're getting stopped out too frequently and none of those trades turn into anything that runs for you in a meaningful way, then you probably have an issue with how tight that stop is in the first place, time frame, and lot size. But you shouldn't be getting stopped out constantly on a trade over a longer time frame, right? Like, should be some room there for you to breathe. So if you're getting stopped out too frequently, then you're either there's something else going on. If you're scalping and you're getting stopped out all the time, like, let's say an example, you were looking at a 1 minute chart, and you were running really tight stops. Like even on this is Bitcoin 1 minute chart. Here's a signal for you, a short